All right. Welcome to Be the Market Expert. And wanted to kick it off with this. I seen this thing circulating around. I don't know if this is the exact one I saw, but it was interesting enough for me that I went and re-hunted it down. And what's interesting about this is, firstly, it's an Instagram article, which isn't what makes it interesting. But if you look at it, it says 71%. That's the share of real estate agents who didn't close a single deal yet last year, according to a recent article from Inman. Okay, so where was this posted? This was posted February 3rd. And if I were to look at, February 3rd and do a little bit of research, this was actually from 2025. All right, so this is an article that is being portrayed as gospel of what is happening inside of our real estate market. And the article that they are referencing is from January 24th, 2025. And yet this is circulating around. And so wanted to bring this just because I think a lot of times we're going through, we're seeing these things popping up, right? And I just think about the real estate agent that posts, oh, the Fed just met, rates are going down, da da da, call me, whatever. And it's like, okay, we got to do a little bit more research. If we want to be the real estate economist of choice, we have to dig a little bit deeper. And so while we're looking at this, 71%, guys, this isn't real. I think that when I did see something, it was closer to like, it was like 50%. Like it wasn't like significantly better, but yet this is not real. All right. So as we're going through here, I would just say, like, hey guys, let's make sure that before we go out and post anything, before we start championing anything that's going through, before we start judging our insides off of other people's Instagram accounts, let's go through and let's just do some market research. But let's shift gears a little bit. All right. So Housing Wire, and it says when cheaper rates make homes less affordable. Okay, I'm interested. This is what Zillow, Redfin, and Realtor.com data reveals. All right. Zillow, Redfin, Realtor.com, we know that these are big aggregates of data that are coming through, right? Realtor.com, Zillow, Redfin, like they have a lot of stuff coming through. They have a lot of users on their websites, and so they're able to pull some data. Then it goes forward and says why lower mortgage rates don't automatically make homes more affordable. All right. So if anyone has been following the real estate market for the last 10 years, less actually, but let's just call it 10 years, you know that we lived through a time in 2021 where it was the wild, wild west. We had the lowest interest rates that we have ever seen. And that did not equate to affordability. Yeah, the cost of money was cheaper, but we also saw home prices going up. We also saw some things where appraisals weren't coming in the way that they needed to. And we saw people coming out of pocket, which leads to this. It says, listen, most buyers are conditioned to believe that they need to wait for interest rates to fall and homes will finally be affordable again. All right. So, as real estate agents, as the real estate economists of choice for our people, we understand that this is just not true. All right. We understand that just because the cost of money is cheaper doesn't necessarily mean that the home is more affordable. All right. And it says, hey, this does sound logical, right? The lower the rates should mean the lower the monthly payments, and that means affordability. And yes, that's probably where a lot of our people live, right? A lot of our people are going to go through and they're going to hear CNN, Fox, YouTube, X, insert whatever here, Instagram, that is talking about waiting for these interest rates to fall. And what we have seen over the last couple of weeks and honestly months at this point is that people have been sitting on the sidelines. They have been looking at these news outlets, and these news outlets have been promising silver tsunami, Airbnb bust, the housing crash, interest rates dropping, and none of this has come to fruition. And so now we're seeing buyer fatigue, right? Their butts are sore from sitting on the sidelines waiting to jump into this buyer pool. And it says, but history actually shows us something very differently, something counter to what we have been led to believe that when interest rates do fall, home prices usually rise, which may make homes less affordable. So remember, this is the premise. Interest rates go down. So that means the cost of money is going down. Okay, cost of money goes down, monthly payments going down, at least from the purchase price to what the bank is loaning you versus the purchase price of, at 6% or at 7% interest rates. All right. So as we're looking at this and we're going through what happens, well, more buyers have more purchase power. More purchase power brings more buyers. More buyers brings, I'm going to say, more interest to the same properties because we have an inventory shortage. All right. I know that feels weird. And we're going to look at some other data today that's like, well, do we really? But yes, we absolutely do. And so this is why we haven't, guys, and be thinking about this. If we were to look from 2021 until today, all right, 2021 until today, and we were to look at home prices have not drastically dropped. I mean, go look in your neighborhoods, go look on Zillow. If you own a home, go look at your Zestimate, if you will, and go look. And what you will notice is that we have not seen some massive housing crash as far as the price is going. We've sat at elevated interest rates. We have sat at fairly low inventory, and yet homes are sitting. No one's taking massive price cuts, right? Yeah, we do have some motivated, we have pockets of motivated people that have life events that are happening. And those life events that are happening, right? Death, divorce, marriage, kids, insert whatever here, that is making them make some decisions. And maybe those decisions are strong enough to where they're walking away from where they believe their home should be priced. But yet necessarily not many people are losing money on their homes. So it says, and the reason is simple: when more buyers rush in, the number of affordable homes changes, right? It says the demand outpaces supply and the conditions for affordability storm is in full effect. All right. The biggest affordability force, right? As we look at this, and this is one of the things we need to keep in mind, we're having conversation with our consumers. We're getting into the spring market, right? Like, especially today, outside of like a couple of minutes where it was cool and windy and wet, like it's a pretty warm February day. And so we're going to go through and we're going to see what's going to happen is your buyers are going to wake up. They're going to be ready to go. And they're probably already looking on Zillow, right? They're probably on Zillow. They're looking at homes. They're just sitting at home, right? Think about this, everyone. We have HGTV. HGTV has many of viewers that are sitting down and they are focusing on walking through people's houses from their living room to see what houses look like. Like, we have an exciting job. It says the biggest affordability issue we have today in the housing market is not interest rates, it's the inventory. There's not enough inventory, guys. Because here's the thing: if there was enough inventory, we did have this silver tsunami, this Airbnb bust, just like all of these homes hitting the market. What would happen is home prices would go down. And then the interest rates wouldn't necessarily matter, right? If we go down through and just think about this, if the home prices in Colorado dropped to on average $500,000 from where we're sitting at around $600,000 at the interest rate that we're sitting at, you would have more buyers. More buyers would be interested, but yet we don't have that. So it says when rates fall even a little bit, buyers surge back into the market. And this pattern, right, we're going to see it. So it says this is what Zillow says. So Zillow, their housing value index is one of the clearest consumer facing measures of home values, right? It's going to track the typical value of the homes across the entire housing stock, which is single family, co-ops, and condos. And you can see this, and it says during the pandemic, low rate environment shaded, right? Here we are. There's your pandemic. It says home values rose nearly 38% from February 2020 to May 2023. Okay, so 2020, global pandemic. 2021, we had the lowest interest rates that we have seen in recent history. 22, what we saw was this hockey stick, if you will, that it was going, and then it went up quickly. It wasn't the fact that we saw super high interest rates; it's the velocity of which they went up, which spooked a lot of people. Then in 2023, they stayed elevated, and so guys, you can see this during this time. Why would home prices continue to go up when we are truly looking at an interest rate driven society? Well, it says Prices barely dipped in 2022, even though the mortgage rates doubled. So mortgage rates doubled. Remember, we saw 2-3% gift from God, right? And like a lot of people are waiting for that. They're saying, wow, we're waiting for interest rates to drop to 2 and 3% again, yet they never will, right? 2 and 3%, how we got down there was a global pandemic. A global pandemic forced the interest rates to drop. And unfortunately, that's what led to where we are today with inflation and everything else that happened, right? Cost of eggs, cost of gas, right? All these other things, cost of real estate, right? We can see that it had some pretty big impacts. And so before these things ever trigger again, they're going to say, okay, if we do this, what will be the long-term effect, which we are seeing? So in 2023 and 2024, prices resumed climbing as inventory stayed tight. And in Colorado, we've seen a little bit of a dip, right? And we're going to look at this. We have some of the highest inventory in the nation right now as far as percentages go over previous time periods. But as we're looking at this, is what Zillow's seeing. Okay, well, what about Redfin? Well, what Redfin's showing us is prices are still above their 2022 peak. And remember, the 2022 peak, it was in the beginning of the year. Beginning of the year, right? Because what we saw is, again, super low interest rates in 2021. And then in 2022 started the beginning to mid-year, we saw them spike quickly. It says in 2020 and 2021, monthly price gains consistently ran above historical norms, posting year over year increases of 15 to 20%. All right, 15 to 20% year over year increases, everyone. Firstly, that's astronomical. What we do know is since the 1990s, home prices on average have increased 4% year over year. What we also understand in that 4% year over year, there's only like 2-3 dates in recent history where we saw home prices go down across the board. And there's a movie on it. It's called The Big Short, and that's everyone's homework. If you haven't seen it, I'm seeing more and more stuff around The Big Short pop up. It's probably because I talk about it. Zuckerberg's listening, and he just pushes it my way every time I say something. So, guys, go watch The Big Short. It's pretty accurate. It's got some big name actors that are in it, and it will educate you in the sense to where you're going to have consumers that are going to be talking about the housing crash. And you're going to be able to look at some stuff and be able to like, well, things have actually kind of changed. And this is what led to the housing crash. And you're going to be able to talk intelligently by watching a movie. I fully endorse the movie for whatever that's worth. The index showed no meaningful slowdown until mortgage rates doubled in 2022. Okay, cool. So here we are. We're watching it. There's 2020 going up, 2021-ish, 2022 going back down. What happened in 2022? Interest rates. Again, it wasn't that they were high. It wasn't that we had super high interest rates. Again, the velocity of which they went up spooked people. By late 2023 and 2024, Redfin's data showed home prices once again running above their 2022 peak despite 20-year high mortgage rates. Guys, what this is pointing to again is that it's around motivations. People get married, people have children, people get divorced, there's death, there's deployment, there's people getting transferred, there's people taking job opportunity, there's people wanting to move closer to their kids, grandkids, life. We are in the business of helping people with the largest financial decision that most Americans make in their lifetime, which is predicated on life. Yes, 2021 was an anomaly. 2021, we did see people move across the street, right? They were like, you know what? I want a different view. And they could do that because the cost of the money was so cheap that we had these buyers that were making decisions that most people would not make the way that they made them, but it was all predicated on the cost of money. But we are in the life business, right? And so that's why we need to be in constant communication, systematic and strategic with the people that are in our ecosystems, because they're getting their news from all these places like Instagram, which I just showed you was saying in the last month that we had the most real estate agents not doing business from an article in 2025 that they were trying to say that was recent, and it wasn't. And that's where we need to be educated and make sure that we're having these conversations. Well, then we go down and says, well, what is realtor.com saying? Well, it says the supply shortage is the root cause. Okay, so none of these are saying interest rates. Realtor.com's monthly housing inventory report, and specifically the total listing count, reveals the most telling clue. America simply does not have enough homes for sale to meet the demand. And so, yes, we are seeing homes sit longer, especially here in Colorado. But what we're majorly seeing is this: there are buyers that are sitting on the sidelines still. You probably have some that have gone to the family barbecue or insert whatever here that you've been around, and they're on Zillow and they're looking. What we saw was this paradigm shift, this mind shift from our buyers in last year and a little bit in the year before to where they were looking for their forever home. And what that meant was this: they were saying, well, hey, with the cost of money being where it is, I am not going to go and just purchase any house. I want to purchase a house that ticks multiple check boxes so that I do not need to go and spend this amount of money again. Because here's the thing, everyone. What do we know? We know that the average home buyer right now is 40, that the largest demographic between male and female purchasing homes right now is female. We also know that it's mostly when we do see couples, it's actually unmarried couples that don't have children that are purchasing homes, and that the down payment, which hasn't significantly changed over the years, is 10%. Well, 10% in Colorado in the Denver metro area, that's $60,000, $60,000, right? With a price point about 600,000. Now, if you go into Jefferson County, right, which is where the brokerage is located, which we do most of our business, well, that's a $700,000 price point, which means $70,000. So when we're looking at all this, this is why the psychology of where our buyers are coming from is very, very important, because the cost of money is up there. And so they're sitting on the sideline longer, making sure that they can actually check multiple boxes that they're moving forward. Also, at the same time, there's not enough inventory coming onto the board to drop home prices. So some of these homes are sitting for a year, 9 months, 6 months. Why? I saw a slide earlier today. I was going to bring it, but I decided against it, that actually showed that people that actually in the Denver area that have owned their home for more than 10 years have something close to like $300,000 in equity. And that came from realtor.com. It came from, or not realtor, it came from NAR. It was NAR data that they were pulling. And it said, hey, over the last 10 years, we have significant equity in homes. So what does that mean? Despite all the news, despite what's happening in Twitter, X, CNN, Fox News, YouTube, despite the headlines of people losing money, well, yes, I think if you bought in the last 3 years and you bought at the height of the market, and now things are coming down a little bit, yeah, you could lose money, but you only lose money if you sell and you're in one of those situations. For the majority, we have some of the best balance sheets for home buyers, for mortgage holders that we have ever had. And I want you to think about this. We talked about this at the team rally. We're talking the 1990s. Let's call it 1995, just so that we can cover all of the months. 1995, 30-year mortgage. These homes are owned outright. And if we were to look at some of these price points, $200,000, $300,000, some of these homes are worth $1 million now, everyone. $1 million, no mortgage. Depending on what their price point, that's $700,000 in equity. That's $600,000 in equity, right? $800,000 in equity. They can afford to sit on these homes. And what we're also seeing is sometimes they're saying, you know what? Let's just rent it. Might as well make a little bit of dollars, because they also have that, well, I don't want to lose money. Well, and what are they basing that off of? They're basing it off of what their home zestimate was 3 years ago, what their neighbors sold their home for in 2021. So when we go through, it says for the period preceding the pandemic, in the gray, here's your gray, it says the average monthly listing count was let's call it 1.5 million listings. Through the pandemic, the average dipped to 1.1. Okay, so we saw less when the pandemic hit. which, okay, makes sense. And it says for the period post that, the rebound was 1.2. What do we know? Well, we would consider 2019, right? The preceding the pandemic area right here. This is what we would consider a normal market. The normal market is anything pre-2020. Yeah, there's some outliers in there, but what do we have? 2019, normal market. 2020, pandemic, global. 2021, interest rates super low. 2022, skyrocketing interest rates, the velocity. 2023, 24, 25, elevated interest rates. Plus, we had a presidential election. All right, so we had all these different things that are happening. But what do we see here? We see that while we still had a smaller population as far as the United States goes, we still had more inventory. We had significantly more inventory 2019 and before than we do today. And today we have a bigger population of people. Home prices are not coming down, guys. There is nothing that is indicating that we are going to see a massive decrease, a massive price cut in home prices. It would really take war, right? And at that time, is anyone really going to go and start purchasing a bunch of real estate if war happens? Yeah, there might be someone, but most people are not. Let's shift gears real quick. Austin and Denver. All right, this is not a list we want to be on. Significantly oversupplied, lot inventory. Baltimore and Philly home builders still struggle to find lots. Okay, cool. Well, that makes sense. Baltimore and Philadelphia, super compact. All right, they can't find a lot of stuff. We live in Denver, so check this out. Like as we're going to go through, it says here is the new home lot supply index. I'm saying, hey, we're slightly oversupplied as far as single family vacant development lots. Okay, what does that mean? That means that the home builders do not have a lot of faith that they can make a decent amount of money, at least in their investors' eyes, to go through, purchase property, sell it for a premium. Remember, home builders are not the March of Dimes. They are for-profit companies, because there's going to be a lot of people out there that says, well, how come the builders just don't build? Because they want to make money. And if they slow down their process, they can keep their premiums at a rate that they can justify to their investors. All right, let's go through here. So we got dark green, and then we got, let's call this orange. All right, here you guys are. We're number 2. It says we have 82% more inventory this year versus last year for vacant developed lots. All right, so we're looking at this again. So this is vacant developed lots. While a lower lot indicates value, indicates a smaller supply. So we're looking at this, and you're sitting at this 82% year over year change. This is where we're going to go through, and we're going to say, well, all right, with everything that we're seeing, I might want to utilize a strategy to where I am reaching out to home builders to figure out what inventory they have. And maybe I am going to make sure that I'm going to go walk those properties. I'm going to get on their list. I'm going to go figure out what incentives they are offering, because these guys have sales quotas. These guys have investors they need to answer to. And if we're seeing that we have this surge in property that is needing to be sold, well, I should go to the people that need to be selling it, because they sometimes it's a brand new home. Well, it's always a brand new home with a new build, but sometimes they have better things that more people are looking for, right? They can get appliance upgrades. It's a brand new home. They're going to get some kind of warranty, structural warranties on their property. They could get some incentives for a property as well as a lower rate, because a lot of times these banks, these builders are their own bank. And so as I'm looking through this, I'm seeing that we've made a list that and you can actually see that this list that we're on is actually so heavy that it's actually outweighing the other list, the other side of the spectrum. Is I'm going to go through, I'm going to go make sure that I have all these connections. I'm going to do stuff on social media. I'm going to go tour these properties. I'm going to maybe find a home of the week, a deal of the week. I'm going to do these different things to make sure that my consumers know what is going on. When I go to that barbecue and someone starts talking about how inventory or rates, or I'm thinking about buying a house, then I can plug something along the lines of I actually just went toward this new build who's actually giving this incentive to where interest rates are lower than what the general public can get for a resale home. And the house was awesome, right? And being able to spark some of those conversations. Here is, again, this is your Q4 2024 to 2025. You guys can just see this as a more of a bar graph. Here we were, and we have just shifted over. So again, if I were to do this, these are just 30 markets, but I would say that I probably need to know what builders are out there because this is the builders consumer index on how well they feel about the market. I'm going to say with information coming out like this, they are more than motivated, and I want to be their real estate of choice that says, "Hey, let me get this information out. What can you do for my people?" Let's shift gears and let's talk about Housing Wire. Housing demand snaps back as mortgage rates near 6%. All right. So last week I was seeing articles, and last week's articles were talking about how we've hit the winter, the cooling, and all these other things. This was last week. And the weeks before, we were seeing that buyers were out in full force. Then we had this week, and this is what happened. The data lies because what were we seeing? We were seeing a cold front across the nation. Florida had snow, everyone. There was frozen iguanas that were all over social media and other kinds of stuff. I saw someone making iguana tacos. I would never eat an iguana taco, but I saw it. Put it in the chat if you had an iguana taco, because now I'm interested. Now, when we're going through and we're doing this, we see all these headlines of the real estate markets moving. Then we start seeing, oh no, buyers are not feeling good about the market. And then here we are now that it has thawed. I don't know if the iguanas have thawed yet, but the headlines were misleading because it was going through and we saw this snowstorm blow across. We didn't experience it in Colorado, which was very weird, but here it goes. It says housing demand and new listings rebounded as snowstorm effects have faded. And guys, that was what slowed us down. It says with inventory growth slowing and mortgage rates steady near 6%, guys, and this is what we like, steady. Yeah, okay, cool. Some dips are fun here and there. We obviously don't like to see it rise, and yet we want steady. Steady gives buyer and seller confidence. Steady rates. That means people are not going to try to time the market. With mortgage rates near 6% and the snow effect fading away, we got a rebound in weekly housing demand for last week. Remember, this is Friday for rear view facing data. It says, for me, Logan, this is more about the snow impact fading from the data line, as we also saw a pickup in new listings. Cool. So what happens? We're seeing people that are now getting back out there. They're looking at properties. They are purchasing properties, and we're seeing more properties come online. Good thing. Housing inventory picked up. He says a smidge, and the year-over-year price cut percentage is now down almost 1%. Okay, cool. So we're seeing less price cuts. We're seeing more inventory. We're seeing less price cuts. We're seeing more buyer demand. Guys, this should excite everyone on this call. All right. So here's your weekly pending. We're looking at this and we pop up and we're looking at it. We're right in the mix. So weekly pending sales is going up a smidge, he says. So this is good, right? We want to make sure that we're going through and we're seeing buyers find homes that they like and they are purchasing houses. Purchase mortgage application data. All right, we've been talking about this because we need to make sure that we understand what we're looking at. Again, this graph, I think they should have more than just 2 years, but he just really wants to show year-over-year data. So in his graph, Logan is showing 2025. Here's your red. And the importance about this graph is not this luge down right here, all right? What's important about this graph is that we are still year-over-year above 2025. That's all I care about this graph. Yeah, we saw this snowstorm, frozen iguana tacos. All right. So we saw this, but again, it's still higher than what we were in 2025 because this is purchase mortgage application data. Now, this is two-pronged, all right? So yes, there is a segment of this purchase mortgage application data of people refinancing their homes. All right, some of this data is refinance. All right, believe it or not, at 6% interest rate, that is better than some Americans have on their homes right now at 8%, at 7%, and it makes sense for them to refi. What we're also seeing though is people, their butts are sore. They're tired of sitting on the sidelines waiting for this Airbnb bust, this housing crash, this silver tsunami, interest rates to go back down to 2%. And what are they doing? They're reaching out to lenders to figure out what they qualify for. Guys, this is a graph that is showing you Americans living in the United States that are purchasing or that are looking to purchase real estate. All this should excite every one of you on this call. These are people that you have relationship with that are interested in what they qualify for in 2026. Now, if you're like Charles, none of my people, none of my ecosystem, none of my community, none of my tribe, my family, my friends, my whatever has reached out to me, well, that should be concerning. That means that we need to go reach back out to them and figure out and get back into relationship. Guys, we are in the relationship business. We are in the life event business. Someone, somewhere, something happened, and these guys have figured out what they are qualifying for. So we're not going to talk about the 10-year yield. We're not going to talk about mortgage spreads, but let's look at weekly housing inventory. Guys, this is good. We're looking at this, and we have more inventory today than we have had since at least 2021. All right, we're going through, and this is what we want to see. We want to see this continue to rise. When we see it continue to rise, that slows down the home prices going up. Who wants home prices to go up? People that are selling their house. That's really about it. Because guess what? If you're living in your home, you don't want your home prices to go up because sooner or later the evaluator is going to see it, and your property taxes are going to go up. People that are typically selling their house, they're also become buyers. Historically speaking, most sellers become buyers at the same time. So even though they're like, yes, I've made a lot of money for my home, unless I'm moving to the Midwest or somewhere where home prices are significantly cheaper. And if I'm staying in Colorado, home prices will still be elevated on the buy side too. So I'm not significantly cheering for home prices to continue to go up because I'm going to eat it on the other end of this thing. So we want more inventory. More inventory means prices start to stabilize, interest rates go down, more inventory goes up. That gives us a better barrier to where we're not seeing so much bidding wars going on and pushing inventory prices up. New listing data. Here we are, right? Like we're going through here. We're still right in the mix. We did see a little bit of a dip. Why? Frozen iguanas again. So as we're going through, this is good. We saw a little bit of seasonality, which was even weirder than normal because, again, Florida had snow. Your price cut percentage. This is where he said, look, guys, we went down to 32% last week. So what we do know, historically speaking, 1/3 of all homes in the nation take a price cut. Okay, so with 1/3 of all homes in the nation taking a price cut, and why do they take a price cut? Well, because there's two homes in the same neighborhood. And the only way for me to make my home look better from my competitor is either I need to enhance the home or I need to drop the price. Most people are going to choose to drop the price versus put in a new kitchen and bathroom, right? When we look at it, that's the lesser of the heartaches is let me just take some money out instead of investing some money in something I don't plan on living in anymore. And so when we're looking at these price cut percentages, even with inventory going up, we are seeing less people have to drop their price. Why? More buyers are coming online, which are taking inventory off the board. And guys, we're seeing this. So we don't know if this is going to continue to play out this specific way, but yet this is good. So what are we looking for the rest of this week? Is that we're going to get a series of housing reports this week, including pending home sales, which he believes will show snow impact, which we already know, as well as new home sales, housing starts, and builder confidence data. And we just saw Colorado. I'm assuming builder confidence data is going to be low. We will also have the Fed Reserve speeches and inflation data. He says it'll be interesting to see what the 10-year yield does. Okay, cool. So why do we talk about the Fed Reserve? And again, what we understand is that we deal with the largest price tag item most Americans purchase in their life. And so while the Fed loans money to banks and that money gets used for a lot of different things, we also know it gets used for real estate. And so in March, we will have, May, we're going to have a new Fed president. That new Fed president, we do believe, will be aligned with the sitting president for the United States. And we should start to see interest rates start to lower. And yet what we will see with that, remember, we live on this teeter-totter, this dual mandate that the Fed is looking at, which means inflation will probably go up. All right. So I just want to preface this on the call for everyone to realize that in order for more affordability for what you all sell, then we will need to have the cost of money go down. And in doing so, that means more buyers will come online for everything, eggs, gas, real estate. And so prices will start to go back up. And so you get to pick the lesser of the evil and have your stance on it. I'm all for prices going up and making the affordability become more affordable for most people. I'm all for that. So let's end it here. Let's talk about interest rates. So guys, if we look at this 1 month, all right, so we're talking January 14th to February 13th. I don't have yesterday's data and it was a holiday, so who cares? All right, so we're looking at this and we're going across, guys, and this is the stuff that bothers me when we're looking at rates. We don't like to see these peaks and these valleys, especially as like significant as this was, in the sense to where we're dropping from 6% below and then we pop back up. And the reason why we don't want to see this, again, sellers become buyers. What we know is there are homes in Colorado that are sitting 30 days, 60 days, 6 months, 11 months plus, because 12 months the MLS kicks it off. And so it's a new home at that point. So what does that mean? Well, when we're looking at this, sellers become buyers. And if a seller thinks, well, hey, these homes are sitting for longer and I cannot lock in my rate until my home goes under contract and I identify a new home, we see hesitancy. Unless they're motivated, right? We see this hesitancy of people wanting to get on the market and sit for months and potentially downsize their home when they weren't intending to, right? Because if interest rates go up, then what happens? Well, the affordability goes down and I'm in this home right now, which means I might have to downgrade my home and my lifestyle because it costs too much. So this is the kind of stuff that scares people. Now, it's not as bad as where we were, right? Like this is really bad. Like we never want to see this, because then what happens? You also have people that are waiting for this, right? And while this isn't as low as where we are currently, this is what goes through. And these people say, well, I'm waiting for the dip. And we know that we can't time the dip, right? There is nothing outside of right now with Fed speeches, the president, life stuff that is happening where these people, they just go in front of a camera, they go on to X and they drop a tweet, and then it sends some of these things in a frenzy. And that's all that's happening right now. This is political. And I want everyone to realize that, like, everything that we're seeing with interest rates is truly political at this point. It going up, it going down. And what we can see this is getting proven is go on to anything, and you're going to see a lot of people talking about housing affordability. You're going to see Congress people, you are going to see senators, you are going to see the administration right now. Everyone's talking about affordability because, oh, go ahead.
You know what this dip was?
Hit me with the dip.
That was when I'm guessing because
Yeah,
on vacation. I think that's when Trump bought the $500 million worth of mortgage-backed securities.
yeah, I think this was the securities dip as well. And it gave some life into stuff, and then it kind of bounced back the other way pretty quickly. And yeah, guys, so like that's what this thing is. And so as we're going through and we're doing this is where we're going to have conversations with our people, right? We're not going to aim for the dip. We do not know what people are going to say or what people are going to do. especially with the current environment that we're in. Anything can be done with a pen at this point. All right. There can be executive orders, there can be all kinds of stuff. That's why we need to be having conversations about figuring out what life motivation is happening inside of their world and helping them navigate this process. What we can crystal ball, right? If my crystal ball, I would venture to say that interest rates do go down this year, and we will see them probably go down more so and more so Q3 and Q4. We will not see 2%. We will not see 3%. We are probably going to see north of 5.5%. But again, based on all the information that we saw, that means more buyers come online. Home prices don't necessarily come down. So this is where we need to be having conversations with our people. The inventory is sitting on the market. Sellers are more apt to come to the table and give concessions right now. They are more apt because they are motivated. It's still the winter. And so they're motivated to have negotiations. But if interest rates come down, more demand will spark. And that means we will have less negotiating power. So, Mr. and Mrs. Buyer, right? This is where we need to go through and be that real estate economist of choice to be able to navigate through this largest real estate financial decision that most Americans will ever make in their life.